This week, the Federal Reserve had what I would consider one of the most important meetings since the onset of the pandemic. What happened and what does it mean for the later half of this year? There's a lot of stuff to unpack. I'm Michael Smith and welcome to the Lowdown. Hey everybody, welcome to Lowdown, and joining us today is Kevin Lenox, and happy Cinco de Mayo. Kevin, happy Cinco de Mayo, and I'll tell you, with this week, I think we really need these. So let's kind of get started here. Well, I thought, let's talk about the Fed. That's been the biggest news of this week and what's happened. I think this is probably one of the most anticipated meetings, and I'll say it's probably one that I thought the Fed Chairman Jerome Powell had to get it perfect, but it went anything but perfect. Why don't you tell me what was expected, what happened, and what does this mean?
Yeah, Wall Street stopped for the 1 p.m. announcement from the Fed, and it went exactly as expected. They raised interest rates by 50 basis points, so 0.5% to 1%. They also announced that they would begin shrinking the balance sheet starting June 1st.
Correct.
By $47.5 billion per month, increasing to $95 billion per month in 3 months. There was very little market reaction to that because it was telegraphed in advance.
Oh, it was advertised.
But as often as happened in the past, the real fireworks come during the press conference. And Powell did not disappoint. He was asked about the possibility of raising interest rates by 75 basis points. He said that that was off the table. That's when markets moved.
So what does that mean? What do you think that means? Why would markets react? Because that's off the table.
Because he's been so conscious of inflation. And actually, he started the press conference with an announcement talking directly to individual Americans, saying that inflation is too high.
Yeah.
And it was their mission, first and foremost, to get inflation under control. And he talked about how good the economy was, that at this point, there's 1.94 jobs available for every unemployed person. But due to supply-related problems, pandemic-related, that the economy is going too fast, and part of their mandate is stable prices, and that was their mission.
Well, with the economy doing well, you would think, well, you're just going to continue with the next Fed meeting and let in the 75 basis point increase happen. I mean, what actually I think this said is that the market's not going to pull the liquidity, right? We've been talking about liquidity when it gets pulled from the market. That's going to be bad. The market's been anticipating that. But that was a pause, which is probably why you saw the big jump. We saw, indices up 3%. I mean, we saw a big jump.
It was the best day since May of 2000, which was not the intention of a day when you raise interest rates, particularly by 50 basis points, which is the first time since 2000.
Yes.
And he said that he would raise interest rates probably another 50 basis points in the next 3 meetings. But it was interpreted as a dovish, if you will, hike. And he would say they would expeditiously move to the neutral rate. Well, we've got inflation over 8%, and the Fed funds rate just went to 1%. Hence the 75 basis point question, to which he knocked that down immediately. And with that, then, Fed credibility went back into the spotlight. And they're talking about raising rates and shrinking the balance sheet, yet they keep their forecast for unemployment at 3.5% for this year and next year, and 3.6% in 2024. I'm sorry, but in my time in the business, when you raise interest rates that aggressively, and let's remember that when you raise interest rates or lower them, it takes several months for that to flow through the economy.
Yeah.
So raising quickly runs the risk that you over-tighten. And so that was the big thing that myself and colleagues with other firms across the country said, that's really not believable. Why are they doing that? So the market saw this as a dovish. They want the market to do the work for them.
Absolutely.
And Powell actually said he's been happy with the way the market has been steering
handling
rates.
this. Yeah.
Correct.
Well, so yesterday, obviously a big move, market to the upside. Then today, you kind of scratching your head, right? I mean, all of a sudden, market's in reverse, and you almost wonder if today everybody kind of woke up and said, "What does this really mean in terms of their pivot?" A lot of it are calling it a pivot, a lot of it are calling it a change. But what does that mean in terms of now for the overall markets?
Well, the announcement to this morning that we got up this morning, markets were flat. The S&P 500 was down about 20 points, as you might expect after a huge up day. But then the Bank of England, Bailey, who was the head of the Bank of England, came out with their version of a Fed meeting. They raised rates by 25 basis points to 1%, but then he let go of a couple of truth bombs. So well, first of all, there was division in the vote.
Okay.
In that several voted for a 50 basis point hike. But Bailey came out with a forecast of inflation ending the year at 10% and GDP next year fractionally negative.
Oh, wow.
Translation, stagflation is real. And then you could just see traders start to say, this is Powell, Jay Powell, head of the Federal Reserve,
yes,
in 6 months or a year. And these central banks, and we talked about the last 2 times, I think, central banks really are sort of trapped.
Well, explain stagflation, by the way.
Stagflation has different definitions. I didn't realize how controversial it was. Okay. But within Bloomberg did a survey of economists and Wall Streeters, and there's like 3 different versions. But I think the simplest way to explain it is a pronounced slowdown in growth, basically stagnation in growth. At the same time, you have inflationary pressures. And what that does to corporate America is it crunches profit margins. So the risk to the market here is that prices go up.
And growth slows.
Growth slows, so companies have a tougher ability to pass along prices. Mm-hmm. Margins get hurt. So then the read-through then is lower corporate earnings, lower profit margins, which then results in lower PE multiples. That's sort of the bearish scenario that's out there, and there are many, many smart people on the bearish side calling for a recession and 20% plus downdraft in stocks, and others that say, you know what, bank balance sheets have really never been stronger. Mm-hmm. Corporate balance sheets are very strong. We're going to do $1 trillion in stock buybacks this year. Which is a record. Yeah. Dividends going up 10%. CapEx, which is business spending, going up about 9%. So corporate America is healthy. And because of interest rates being so low for so long, so many companies took advantage of that.
Absolutely.
To lock in longer term loans or bonds for very, very low rates. You've got some softness among the U.S. consumer, but still overall okay. So as we talked about last time, the clearest path for right now seems to be a protracted slowdown in growth. Could go either way, but it's too early to call for a recession and bear market at this point, just because there isn't that Achilles heel. The housing market.
Not just yet, yeah.
Or inflation is a bit of an issue, but high prices tend to cure high prices over time.
Well, and also a little bit of maybe kind of the past of what we've seen. Remember, you said May of 2000 was the last time we saw a 50 basis point increase, and what happened after that? The dot-com bust. So a lot of that got brought back up, or at least the fears of that got brought back up today.
I'm glad you brought that up, because we look at 60-40 portfolio, and it's had a horrible year, which is something I think every time I was on the radio last year I talked about the risk of just a straight 60-40 portfolio. And when borrowing costs go up, when rates go higher, the valuation metrics that Wall Street uses for growth stocks causes valuations to look extended, because they look so far into the future. Mm-hmm. That rising rates there make technology stocks look extremely expensive. So year to date, well, through yesterday, growth stocks were down, I think, about 20% on the year, whereas value stocks were basically flat. Mm-hmm. So when you look at the S&P 500, which is the most widely held index, a lot of people don't know that about 43% of the weighting of that is on the growth side, and only somewhere 21, 22% is on the value side. The difference is in the middle.
Yeah.
So it's disproportionately affected by how growth stocks move. So as bad as the 60-40 has been, just following business cycle dynamics then and underweighting technology stocks, as you should have been doing in this environment, and focusing on larger quality companies that can buy back their stock, pay the big dividends, there's a huge gap in performance there between that. So many people are still just trapped in tech. And I had a guy tell me, well, that's what I've had for years, and that's you go home with the one that brought you to the dance. I'm like, I really don't understand how dating etiquette should be involved with investing. Yeah.
Well, a poor choice, and it's not going to be successful in the long haul.
So those are the types of conversations I have with people that are saying, from the outside that we haven't talked to before.
Yeah.
That are saying, I've got quality, but what the heck happened? Well, you had quality back in '99 too.
Absolutely.
And people said Microsoft and Intel, those companies will not go out of business. True. It doesn't mean they can't go down 70, 75%.
Hey, Kevin, thank you. It's been a long week. This might be very well needed now. But let's have you back on next week. I'd like to get your thoughts on OTC. We had that in town, so I'd love to get your thoughts. But we'll save that for next week. Thank you for listening to Lowdown.